We're joined now for more perspective on window dressing by Paul Atkins. He's former SEC commissioner. He's now managing director at Potomac Partners. He's in our Washington bureau. Good morning to you, Paul. I mean, Peter points out they're not illegal. Doesn't necessarily mean it's kosher to have window dressing practices here, right? They looked at this while you were at the SEC. Why hasn't anything been done till now?
Well, Margaret, it'll be interesting to see what the actual proposal is. But yes, you're right. This issue has been discussed for probably 10, 20 years for both financial firms and non-financial firms. And a lot of it depends on just what the definitions will be coming out of this proposal as to what needs to be disclosed and how it's going to be disclosed. Some of the tensions are, especially for financial firms, are you tipping the market to what your strategy is versus giving disclosure to shareholders? But one of the real problems with financial firms has been during the crisis and even before is the transparency issues around them for people to figure out just how to value the firm and what it's holding.
Well, cleaning up your balance sheet right before you have to tell the public about it, it either seems like good strategy or some would say it seems a little bit deceptive here. What's the difference between just short-term financing and then a Repo 105 type transaction with Lehman Brothers where they have been accused of essentially intentionally hiding dangerous debt?
Well, it goes to that word that you just used, intentionally. If it's intentional and you're trying to deceive people, then that's illegal. But
how can it not be intentional, though?
Well, in that case, when you're talking about the Lehman case, at least from what has been reported and out of that the facts that were disclosed by the bankruptcy report, it certainly does sound like it was an intentional type of activity. But there are other business practices that just everyday financing of firms, and whether or not it's actually done to try to sort of paint the clothes, let's say, or make the close of the quarter look better or not, those depend on the facts and circumstances of the particular firm and what's going on.
Paul, this is Peter Cook. Let me run a couple of the specifics by you to get your take on it. Specifically, companies can have to report the amount outstanding at the end of a reporting period, the weighted average interest rate on those borrowings, the average amount outstanding during the period, and the weighted average interest rate on the borrowings, the maximum amount outstanding during the period as well. Does any of that sound too onerous to you? And more importantly, do you think it actually will provide shareholders with a better snapshot of what's really at risk here?
Yeah, we'll see. I'd really like to see exactly what they what they're proposing. Just what the language is. It's hard to say based on the oral statements of the commissioners. It's really important to look at what the actual definitions are and what's required to be disclosed. And we've seen in the past where, like what FASB has done with some of their rules, like FIN 48 and others, where what looks very innocuous on paper then suddenly becomes extremely onerous potentially, and so there have to be tweaks to the language to make it so that it's not just becoming a paper chase or something that that has unintended consequences, that releases perhaps too much information to the marketplace that ultimately then hurts the shareholders. So there's a balance that needs to be done.
All right. Thanks, Peter. Thanks, Paul.